When people think about modern warfare, they usually picture missiles, fighter jets, and aircraft carriers. But in today's world, one of the most powerful weapons may not be fired at all. It may simply be geography. That is exactly why the Strait of Hormuz has once again become one of the most closely watched locations on Earth. Every day, enormous volumes of crude oil and liquefied natural gas pass through this narrow waterway connecting the Persian Gulf to the Arabian Sea. For decades, the global economy has depended on this route remaining open. A disruption lasting only days can send energy markets into turmoil, while a prolonged crisis could ripple through virtually every major economy. This raises a critical question. Has Iran discovered that it doesn't need to defeat the United States militarily to impose significant economic costs? Many geopolitical analysts believe Tehran understands that direct military confrontation with Washington would be extraordinarily difficult. Instead, Iran's long-term strategy may focus on exploiting strategic pressure points where relatively limited actions can produce disproportionately large economic consequences. The Strait of Hormuz is perhaps the clearest example. Even without a complete closure, rising tensions can trigger higher insurance premiums for commercial shipping, force tankers to take longer or more expensive routes, increase security costs, and inject uncertainty into global energy markets. Financial markets respond quickly to uncertainty. Oil traders don't wait until supplies are interrupted. They price in risk immediately. That means even the perception of instability can push oil prices higher before a single barrel of crude is actually delayed. This is where economics becomes more important than military strength. Higher oil prices increase transportation costs. Shipping companies pay more for fuel. Airlines face higher operating expenses. Factories spend more on production. Farmers pay more for diesel, fertilizer, and machinery. Eventually, those higher costs move through supply chains until consumers notice them at grocery stores, gas stations, and retail outlets. In other words, what begins as a geopolitical dispute in the Middle East can eventually affect household budgets thousands of miles away. This explains why investors monitor developments around Hormuz almost as closely as military commanders do. Wall Street understands that energy prices influence inflation. Inflation influences interest rates. Interest rates influence corporate profits. And corporate profits ultimately influence stock valuations. A single geopolitical flashpoint therefore has the potential to affect trillions of dollars across global financial markets. Another factor often overlooked is psychological pressure. Businesses dislike uncertainty. Energy companies postpone investments. Manufacturers delay expansion plans. Shipping firms increase contingency planning. Institutional investors shift capital towards safer assets. Consumers become more cautious with spending. These behavioral changes can slow economic activity even if physical supply disruptions remain limited. For Washington, the challenge is unusually complex. The United States maintains one of the world's most capable military forces and continues to work with regional partners to protect freedom of navigation. However, ensuring long-term stability requires more than military deterrence. It also depends on diplomacy, intelligence cooperation, international alliances, resilient supply chains, and diversified energy sources. That is why many economists argue today's geopolitical competition extends far beyond the battlefield. It has become a contest over economic resilience. Countries capable of absorbing supply shocks, securing alternative energy supplies, maintaining investor confidence, and stabilizing inflation may ultimately hold the greatest strategic advantage. Meanwhile, Iran may calculate that sustained uncertainty alone can increase its leverage during negotiations, regardless of whether major military confrontation occurs. Whether that strategy succeeds remains uncertain. Global oil producers have expanded production in several regions. Strategic petroleum reserves exist for emergencies. Alternative export routes continue to develop. Renewable energy is slowly reducing long-term dependence on oil. These factors limit the ability of any single choke point to permanently disrupt global markets. Even so, the Strait of Hormuz remains one of the world's most influential economic pressure points. It is not merely a narrow stretch of water. It is a gateway through which energy, trade, inflation, investment, and geopolitical influence all converge. The real lesson is that modern power is no longer measured solely by military capability. It is increasingly measured by the ability to influence global markets, shape investor expectations, and alter economic behavior without necessarily firing the first shot. That may be why every new development involving the Strait of Hormuz immediately commands the attention of governments, central banks, multinational corporations, and financial markets across the globe. Because in today's interconnected economy, a crisis in one strategic waterway can quickly become a challenge for the entire world.